What if getting rich had less to do with earning more and more to do with building a machine that keeps making money while you sleep? Most people believe wealth comes from finding the perfect investment or landing a six-figure salary, yet millions of high earners still struggle to build lasting wealth. Today, we're going to uncover the Wealth Flywheel, a simple investing and compounding system that quietly turns ordinary income into extraordinary wealth over time. By the end of this video, you'll understand how money begins working harder than you do, why time matters more than timing, and how beginner investors can start building momentum with surprisingly small amounts. This isn't theory. It's supported by decades of market history, economic research, and the same principles used by many of the world's most successful long-term investors. And the first surprise is that the flywheel doesn't begin with investing at all. Imagine trying to fill a bucket with a giant hole in the bottom. That's how most people manage money. They focus almost entirely on increasing income while spending quietly expands to match every raise. Economists call this lifestyle inflation, and it's one of the biggest reasons wealth remains out of reach. According to the U.S. Bureau of Labor Statistics, consumer spending tends to rise alongside income for many households. The wealth flywheel begins by plugging the leak before adding more water. Every dollar not spent becomes fuel for future investments. Think of each saved dollar as a tiny employee you hire today that can keep earning for decades. Before that employee starts working, though, it needs a destination. The first stage of the wealth flywheel is creating investment fuel. Suppose Sarah earns $70,000 per year and increases her savings rate from 8% to 18%. Without receiving a promotion, she creates an additional $7,000 annually to invest. That's nearly $600 every month flowing toward future wealth, instead of disappearing into expenses that provide only temporary satisfaction. Picture a conveyor belt feeding logs into a giant power plant. The more consistently fuel arrives, the more electricity the plant produces. Investing works the same way. The amount matters, but consistency matters even more. Before worrying about stock picks or market timing, you need a system that never stops delivering fresh fuel to your investments. Here's where almost everyone becomes impatient. During the first few years, compounding feels disappointingly slow. A portfolio growing from $10,000 to $11,000 hardly seems life-changing. But that's exactly why the wealth flywheel works. Like pushing a massive flywheel in a factory, the first rotations require the greatest effort while producing the smallest visible results. Eventually, momentum builds until each rotation becomes easier than the last. Albert Einstein may not actually have called compound interest the eighth wonder of the world, but the principle remains extraordinary. Small gains begin generating their own gains. The real surprise isn't how much money you invest, it's who starts earning the next return. Imagine every invested dollar as a worker joining your company. At first, you have only a handful of employees producing modest output. Then each employee recruits another worker. Soon those workers recruit even more. That's exactly what reinvested dividends, interest, and capital gains accomplish. Instead of spending investment earnings, you allow them to purchase additional assets that generate even more income. According to long-term market research, reinvested dividends have contributed a substantial portion of total stock market returns over many decades. The flywheel speeds up because your original dollars are no longer working alone. But choosing where those employees work is just as important as hiring them. Many beginners spend thousands buying products from incredible companies while never owning a single share of those businesses. Every time someone buys an iPhone, orders from Amazon, or drinks a favorite beverage, profits often flow to shareholders. The wealth flywheel encourages thinking like an owner instead of simply a customer. Broad market index funds allow beginners to own tiny pieces of hundreds or even thousands of companies with a single investment, reducing the risk of betting everything on one stock. It's like planting an entire forest instead of hoping one tree survives the storm. Once ownership begins, another powerful force quietly accelerates your progress. Compounding alone is powerful, but combining it with regular investing creates a second engine driving the wealth flywheel. Imagine rolling a snowball downhill while continuously packing on fresh snow. That's dollar cost averaging. Instead of trying to predict market highs and lows, you invest the same amount every month. When prices fall, your money buys more shares. When prices rise, existing investments become more valuable. Consider someone investing $500 every month for 20 years. Those steady contributions may total $120,000, but historical long-term market returns have often produced substantially higher ending balances, although future returns are never guaranteed. Now let's see how this changes an ordinary family's future. Meet Jason and Emily. They aren't investment experts. Together they earn $95,000 annually and decide to automate $800 every month into low-cost, diversified index funds. They ignore daily headlines, avoid chasing hot stocks, and increase contributions whenever they receive raises. 5 years later, friends brag about quick cryptocurrency wins, while Jason and Emily appear to be moving slowly. 10 years later, their portfolio has grown large enough that annual market gains sometimes exceed what they contribute themselves. The flywheel has begun spinning under its own momentum. Suddenly, their investments are producing more wealth than additional overtime ever could. That leads to the biggest mindset shift of all. Most people measure financial progress by salary. Wealthy investors often measure progress by productive assets. Salary depends on showing up for work tomorrow. Assets continue producing value, whether you're working, sleeping, or on vacation. Visualize two ladders standing side by side. One climbs through promotions and raises, the other grows through ownership, reinvestment, and compounding. The first ladder can stop unexpectedly. The second keeps extending itself as long as you continue feeding the flywheel. Once you understand this difference, investing stops feeling like sacrificing today's money and starts feeling like buying future freedom. In the next section, we'll reveal the hidden forces that can either supercharge your wealth flywheel or quietly destroy it before you even notice. Now that your wealth flywheel is spinning, 3 invisible forces constantly try to slow it down. Think of them as friction against a giant wheel. The first is high investment fees. A 1% annual fee might sound tiny, but over decades, it can cost hundreds of thousands of dollars on a large portfolio. The second is taxes triggered by unnecessary buying and selling. The third is emotional investing, panic selling during crashes, and chasing excitement during booms. Each one quietly steals momentum. Remove the friction, and the same amount of money travels much farther. The next surprise is that market crashes may actually become your greatest opportunity. Most investors see a market crash as a disaster. The wealth flywheel sees a clearance sale. Imagine your favorite grocery store suddenly cutting prices by 30% for several months. You wouldn't stop shopping, you'd probably buy more. Yet investors often do the opposite with stocks. History shows that major declines have repeatedly been followed by recoveries, although timing and future performance are never guaranteed. During downturns, every automatic investment purchases more shares than before. Those additional shares become powerful wealth generators when markets eventually recover. The greatest gains often begin during periods when investing feels the most uncomfortable. That's why discipline beats prediction every time. Let's put the entire system together. Step 1. Earn income. Step 2. Spend less than you earn. Step 3. Automatically invest the difference into diversified assets. Step 4. Reinvest every dividend and distribution. Step 5. Increase contributions whenever your income grows. Step 6. Ignore short-term market noise and repeat the cycle. Picture 6 gears connected in a circle, each turning the next until the entire machine accelerates. Miss one gear and the system slows dramatically. Keep all 6 engaged and momentum compounds year after year. Most people know individual pieces of this process. Very few consistently connect them into one self-reinforcing machine. Meet 2 friends, Alex and Brian. Alex begins investing $500 per month at age 25 and stops after 15 years. Brian waits until age 40 but continues investing the same amount every month until retirement. Even though Brian invests for more years and contributes far more money overall, Alex can still finish with a larger portfolio because those earlier dollars compound for decades. Think of planting 2 identical trees. One receives a 15-year head start. No amount of extra watering later completely erases that advantage. Time isn't simply another ingredient in wealth building. It's the multiplier that magnifies every other decision you make. Consider Maria, a project coordinator earning $65,000 annually. Instead of celebrating every raise with a newer car or larger apartment, she follows one simple rule. Every salary increase automatically boosts her investment contribution before she adjusts her lifestyle. A 5% raise becomes another step powering the flywheel instead of another expense. Over 10 years, her paycheck grows steadily, but so does the percentage invested. Eventually, her portfolio begins generating annual gains approaching an additional paycheck. Her employer unknowingly gave her income, but Maria converted those raises into long-term ownership. That simple decision transformed temporary earnings into permanent wealth-producing assets. Every year there's another investment everyone claims will make people rich overnight. .com stocks, meme stocks, cryptocurrency booms, artificial intelligence speculation. Some investors make impressive gains. Many arrive after prices have already soared. Imagine sprinting to catch a train that's already leaving the station. Sometimes you make it, often you don't. The wealth flywheel doesn't rely on predicting tomorrow's hottest trend. Instead, it owns broad sections of the economy and allows innovation to work on your behalf automatically. Today's superstar company may eventually become part of your portfolio without you having to guess correctly. Quiet consistency usually beats exciting predictions. This is the moment the wealth flywheel becomes truly remarkable. At first, nearly every dollar entering your portfolio comes from your paycheck. Years later, investment growth itself begins producing larger gains than your annual contributions. Imagine investing $15,000 during a year, while your diversified portfolio grows by $40,000 because of long-term market appreciation. Suddenly, your money generated nearly 3 times your personal contribution. It's like watching dozens of employees produce far more value than the owner working alone. This doesn't happen overnight, but once momentum reaches this stage, wealth often accelerates faster than most people ever imagined possible. The best wealth flywheel isn't complicated. Start by calculating exactly how much you can invest every month after covering essential expenses. Build an emergency fund so unexpected costs don't force you to sell investments at the wrong time. Open a low-cost brokerage or retirement account. Automate monthly contributions into diversified index funds. Reinvest every dividend. Increase contributions whenever your income rises. Review your portfolio once or twice a year instead of every day. Visualize setting a massive wheel in motion. Your job isn't to keep reinventing the machine. Your job is simply to keep giving it another steady push every month. Most people spend their lives working for money. The wealth flywheel slowly reverses that relationship until money begins working for them. That's the real transformation. It isn't becoming wealthy overnight or finding a secret investment that nobody else knows about. It's building a system where every paycheck purchases assets, every asset creates more assets, and every year the machine grows stronger than the year before. Once you see wealth as a flywheel instead of a finish line, every financial decision looks different. Thanks for watching. If you enjoyed this video, please like, subscribe, and turn on notifications so you don't miss the next one. See you in the next video.